without further ado, I'm very excited about this next panel on digital currencies, cross-border payments, and tokens. And I would like to introduce Robert Faroknia, who will moderate this panel. So Robert teaches at the School of Engineering, Business and Engineering at Columbia University, and he's also the founding executive director of Columbia's FinTech initiative, which is officially entitled Advanced Projects and Applied Research in FinTech. So over to you, Robert.
Thank you, Sani. Appreciate the kind intro. Good morning to all the participants. What a treat it is to be invited back to the FinTech conference at the Federal Reserve of New York, and also to start the conference with our panel, which I'm also quite excited about. My name is Robert Faroknia, and the way I like to describe myself is someone who loves to sit at the intersection of things, in my case, academia and practice. And the panel also represents truly intersection of academia and practice. So I'm hopeful to have a very interactive and lively conversation with the panelists and the audience members. Feel free to submit questions through the Q&A box, or you can raise your hands and I will call you in the order of questions, hands raised. So I'll quickly introduce our panelists and kind of set the stage for our conversation today. We'll hopefully have a kind of all-encompassing, holistic view onto everything that's happening in the world today, including the effects of the pandemic. So for those of us who are interested in innovation in financial services in general, and FinTech in particular, the past decade or so have been quite exciting times. We have a development and deployment of a series of tools and techniques, everything from smartphones, which are essence of computers in our pockets with GPS capabilities and camera and so on and so forth, to the famous Satoshi paper, blockchain, and digital tokens. So a whole lot of new tools have come to be. And with that, there have been a lot of hopes in regard to truly disrupting and looking at financial services on the ground up. But as Beverly mentioned, also trying to address some of the shortcomings of our legacy systems, especially for the underbanked or the unbanked. And obviously the pandemic brought to bear and highlighted some of the truly shortcomings of the systems in achieving our fiscal and monetary objectives, especially during a time of crisis. I'll talk about briefly some of the research my colleagues and I have done in this area specific to the current pandemic. And then we'll also use the expertise of all the panelists in that regard. So without further ado, it's my pleasure to introduce our panelists who will discuss all these topics from a variety of different perspectives. So first, Hannah Halaburda, who's Associate Professor at the Department of Technology, Operations, and Statistics at NYU Stern School of Business. And then Christian Catalini, who's the co-creator of Libra and chief economist at Libra Association, currently on leave from his role at MIT. Jesse McWaters, who's a vice president at MasterCard, who's leading the global digital public policy at the company. And finally, Christopher Calabia, who's the senior advisor for supervisory and regulatory policy at Bill and Melinda Gates Foundation. So Hannah, I'll pass the baton to you. Our goal is to have a 10-minute per presenter for their presentation and hearing their remarks. And afterwards, we'll have about 20 minutes or so of a moderated discussion with all the panelists. And then I'll open it up to Q&A for all the participants. So Hannah, the floor is yours.
Thank you very much, and I'm very excited to speak at this panel with this particular set of people. So the reason why we talk about digital currencies and tokens in the context of cross-border payments and financial inclusion is it's closely related to Bitcoin's promise. So the Bitcoin has been introduced in 2008, 2009. It became a mainstream, entered mainstream media in 2011, and it is the first functional currency, digital currency, that does not require any trusted party. So it doesn't require any government to operate. And therefore, it's inherently international. It doesn't require any intermediary that can charge high fees, so it can allow for low fee or cheap transactions, and this was the case with Bitcoin until 2017. Now we know better. And it also is permissionless, which means anyone can join. So it seems to have been made for cross-border payments, micropayments, and facilitating financial inclusion. But despite a lot of stories about usage of Bitcoin in Argentina, Venezuela, China, or Russia, it really didn't fulfill this promise. And we don't have the full spectrum of reasons why. There are many reasons why. But one would be the requirement of tech savviness, that you needed to be tech savvy, and you needed to have access to equipment to participate in the Bitcoin system. And even more important, so-called the last mile problem. And so, first of all, until the whole economy is Bitcoin-based, if you get your remittances in Bitcoin, then you need to transfer them to local currency, and that may be a problem in some remote areas, and especially if you are not technically savvy to go on exchange and do that. So, despite the stories that we have heard in 2015 that now remittances with Bitcoin are going to be frictionless, and they are not going to rely on intermediaries, greedy intermediaries that take advantage of unbanked and poor, we didn't get there. In the meantime, the attention has shifted from Bitcoin to blockchain at large, especially permissionless blockchain. So it has been said, okay, Bitcoin is this difficult thing to use, but we can use blockchain for in other systems, and it has the same features. There's no authority operating, therefore it holds the same cross-border promise. Anyone can join, so it's not only financial inclusion, but also democratization of services. You can have new entrants coming with their payment services and financial services, and we do not need to rely on the large trusted financial institutions of the old times of yesterday, because blockchain affords us this immutable, decentralized, and trustless environment. Right? All great. The problem is that it doesn't really afford that. So the permissionless blockchains are not fully immutable, and they offer only limited decentralization in practice. So they are not immutable because their safety is assured not just by technology, but by incentives. So, for example, for proof of work blockchain, like Bitcoin or Ethereum, the cost of mining is directly linked to security. So an attacker would need to redo the same work as the miners. So the costly that the mining is, the costly it is to attack. But if there is large enough gain from attack, or for example from double spending attack, then the attack is still worthwhile and can be successfully executed. And there is a number of examples of permissionless cryptocurrencies that have experienced successful double spend attack, like Bitcoin Cash or Ethereum Classic. It does also not guarantee decentralization, because even though anyone can join and anyone can become a validator, mining is risky and costly, and different miners have different costs of mining. So miners' risk aversion leads them to join together in mining pools, and that leads to centralization. And right now, as we know, we have in Bitcoin, basically 3 mining pools hold 80% of mining power. that's quite dangerous for a blockchain. And even without mining pools, the cheaper miners would get a larger share of mining, and that would lead to centralization. These arguments may be specific for proof of work, and since about 2011, the community has been working on other consensus mechanisms that would prove immune to some of those issues. And we have like proof of stake is the most important one, but there are other alternative mechanisms. They have their own problems. So permissionless blockchains definitely have a lot of issues, and they do not really deliver fully on the promise as taken, verbatim, immutable and decentralized. It turns out, in fact, that it is permission blockchains that may deliver on decentralization, on this decentralization promise better than permissionless. And it's kind of ironic because the common conception is that permissionless blockchains allow anyone to join in, and permission blockchains require this permission. So there is a natural limit to how many people can join in, how many players can join in. But even though there is this promise of decentralization, in reality, the permissionless blockchains do not deliver on it because once permissionless blockchain is live, there is no one and no way to guarantee that a lot of players are going to join and keep maintaining the ledger. And participating in the system is costly in terms of skills, in terms of equipment, time. And the more costly it is, the more centralization we are going to see. And this is why what we see in cryptocurrencies, many cryptocurrencies, we have few developers dominating the development progress of the blockchain, and a couple of very powerful miners, which is undermining the premise of the blockchain. Permission systems, on the other hand, exactly because there is this off-chain possibility of contracting with known and accountable players, can guarantee a certain level of decentralization. They can guarantee a minimum number of validators that are going to participate in the system. And at the same time, I'm not saying that any permission system is going to be more decentralized than permissionless system. But we can design permissioned blockchains that are going to guarantee higher level of decentralization than what we achieve in equilibrium in permissionless blockchains. It also turns out that permission blockchain may do better on immutability. So immutability also needs to be qualified a little bit. Financial transactions often involve mistakes. And they may be mechanical glitches or human errors like fat finger transactions. And full immutability that does not allow to fix those mistakes may not be so desirable. What we really need and a system that performs better instead is a system that is both secure and flexible. And flexible in a sense that the validators have the ability and want to reverse mistake transactions. At the same time, they are deterred from making changes that are self-serving and abusive to the ledger. So we would like to have the best of the both worlds. So it turns out that if we have a permission blockchain with large but not too large number of known and accountable validators, it can perform better on those two dimensions than a fully permissionless system or a fully centralized system. Again, it needs to be a well-designed permission system, and those are tricky to do. But it seems that we are, we have made a progression from looking at Bitcoin as this new great promise to permissionless blockchains, and now we're looking at permission blockchains as this new great promise about around the systems that are going to fix cross-border payments and financial inclusion. So With that, we need to remember that there are the usual caveats and dangers of permission blockchains. We actually do need accountable players. We need to be able to know them and trust them, and it is reflected in the change of the language. So it's for permissionless systems, we're talking about trustless systems. Now we are talking about distributed trust. Those players can interact, and they do have a lot of interaction outside of the blockchain, and they can coordinate. They could coordinate. They know each other. And there are a lot of bad things that can happen in blockchain if validators coordinate. But even if it works well, what is the benefit of those permission blockchain systems for cross-border payments and financial inclusions? Right? To answer that, we first need to ask what is why doesn't it work? What do we need to fix? So for cross-border payments, the biggest difficulty in achieving cheaper and faster and more inclusive transactions is the difficulty in coordinating ledgers in separate systems, right? It is not about digital, but it is about reconciling those digital ledgers. We already have them digital for a large part. And here, a shared ledger, also known as blockchain, this is what blockchain is, maintained by accountable and well-trusted system of accountable players, may actually do the job. But how about financial inclusion? Why people are not using the bank services more? Maybe the lack of identity proof, government-issued identity proof, maybe an issue of legal status. They may just not have access to the system. It may also be that they choose not to use it because it's too expensive. It is too expensive because it is not profitable for the banks to provide services to certain groups of populations. It may be the lack of technology, but now with the cell phone proliferation and banking apps, the problem that the bank is far away is actually not such a big problem. So what can the blockchain help us with? Well, if somebody doesn't have government-issued identity, blockchain is not going to help that, or at least not the payment blockchain. The same with legal status. The technology is similar. So we really need to ask about the cost effectiveness. What would be the new business model that is possible here? Why would the parties that are maintaining this permission blockchain find it worthwhile to provide services that the banks did not find worthwhile to do? And let me stop here with this question, which I think Christian will be taking on as well. And thank you very much. Looking forward to Q&A.
Thank you so much, Anna. So, Christian, the floor is yours for the next 10 minutes, please.
Thank you. And you'll see me go relatively quickly since you'll have the slides anyways in the recording. It's a real pleasure to be here to talk a little bit about the thinking that has gone into the Libra project over the last 2.5 years. It all started from the mission. Too many people around the world, as Anna was already mentioning, do not have access to basic financial services. And if you think about the cost of cross-border payments, the average, according to the World Bank, is about 7%. Of course, there's a wide variation around that. And it can take also a lot of time when you think about how long it takes to complete one of these payments. When you look at the causes of this, often it is the lack of competition. The fees for sending money cross-border are not just higher where you have higher compliance, AML, CFT costs. They tend to be higher where you don't have many players, when you don't have competition, where consumers don't really have a choice. Now, the good news, as Anna was already mentioning, is that, and I think this slide is not displaying properly, is that we have about 1.7 billion people that are currently unbanked, but about 1 billion of them as a mobile phone. And a large share of that also have access to data. And this is where kind of blockchain technology comes into the picture, not only for its ability to cheaply verify state and digital information at a lower cost, but also for the ability to really bootstrap and operate a digital ecosystem, think about a payment network as a first step, without really assigning control and market power to any single intermediary. So from an economics perspective, really boils down to new forms of market design and new types of arrangements for designing digital platforms. In Libra, there's at least 3 major economic objectives. The first is building trust in an efficient medium of exchange and in the payment network. The second one that is less considered and actually relates to a lot of the issues that Hannah was surfacing around other consensus algorithm is how do you ensure that the resulting market for payments and financial services is competitive and that you get really hefty competition between different providers, whether they're financial incumbents, tech incumbents, or new players and startups. The last one, which is the hardest one to achieve for a blockchain ecosystem, is really the trust in the future governance and evolution of the network. I will go really quickly through these. The first one, the payment tool on Libra, there will be two types of Libra coins. Single currency stable coins, think about a Libra dollar, Libra euro, Libra pound, and so on. And then a multi-currency LBR, which is really meant to be cross-border and to facilitate exchange for regions that do not have a single currency stablecoin on the network yet. Now, the design of these is actually breaking new ground in the design of stablecoins in general. We've been applying the Basel III framework very much as if Libra was a bank, in kind of building on the feedback from regulators that given the same type of risk, we should also use the same type of rules and regulations around this. Each one of the single currency stablecoins will be fully backed one for one, and there will be additional capital requirements and buffers, and I'll get to that in a second. The broader goal is one where Libra will transition out of managing a reserve and will actually integrate directly with the public sector as efforts around wholesale CBDCs or synthetic CBDCs kind of develop further. The idea is to enable low-cost transactions both for domestic and for cross-border payments over a number of years. Now, the multi-currency LBR is really just a digital composite of the underlying single currency stablecoins. You can think of it as a digital version of the SDR. These are fixed nominal weights, and the idea is really to move together the single currency stablecoins and reduce volatility for the receiver. Together with the feedback that we received from regulators, a lot of the changes that we've done in the second version of the Libra white paper are really targeted at building protections that can ensure the reserve can withstand extreme market conditions. So think not only about the recent market stress due to COVID, but also 2008 and other events. And so the idea is really to ensure that not only the reserve is fully collateralized one for one, but also can absorb losses due to credit, market, operational risk, and of course, liquidity risk. The idea is really to ensure that not only this is done in a very transparent and easy to audit fashion, but also that over time, it can really build trust and comfort in whoever is using this, whether it's a consumer or a business. When it comes to regulatory capital requirements and buffers, this is, again, very much applying the Basel III framework. So Libra networks will be expected to maintain a traditional Pillar 1 capital requirement and additional capital buffers in case, for example, there's a large interest rate shock. Given that the reserve will be backed pretty much entirely with government treasuries of the relevant currency. So, U.S. treasuries of 90 days or less for something like a Libra dollar. And then over time, if there is such a thing as a digital dollar, integrate directly and stop operating that Libra dollar reserve. As I was mentioning, transparency and auditability are really important in the system to really ensure that can prove that the assets on chain, and so kind of the easy digital verification really matches with the offline one, with the bank accounts and the treasury holdings. The goal here is really to build a public-private collaboration around how can we integrate network of this type, and of course the public sector may want to integrate multiple networks, just with not just with the Libra one, in deploying CBDCs, wholesale CBDCs, so that can actually benefit and create new use cases for consumers and businesses over the long run. And so our plan is really to be able to support different levels of engagement with the public sector, depending on how fast the public sector advances in different regions. The second dimension of trust in Libra is really the competitive dynamics. When we started this work about almost 3 years ago, we went through a careful economic review of all the consensus algorithms. It turns out that there hadn't been a lot of economic work, especially on the market design side, in thinking about what do these consensus algorithms look like in equilibrium. Many of the systems are not in equilibrium. I think we've seen increasing concentration, as Anna was mentioning. But one of the reasons why we ruled out proof of work, beyond, of course, the wasteful computation and the impact on the environment, was because we could not rule out a scenario where you do get concentration in the long run, regardless of what kind of work protocol you use. And essentially, you get concentration. And against that concentration, your only force is really the threat of a fork, which is pretty weak. This is why Libra is vaguely inspired by a proof-of-stake system, but it's actually bootstrapping trust in the system through initial members that do have an established reputation offline and are really porting that online, defending the network in the early phases when it's really most vulnerable. It's all designed to be an open technology standard, like the open technology standards of the internet, with low switching costs, low barriers to entry, and high degree of interoperability. The idea is through that to really innovate and lower prices, induce improvements in quality, and eventually serve those unbanked and underbanked segments that are excluded at the moment. Which leads me to the really brief last topic, which is the trust in the overall governance and evolution of a network of this type, and especially of that delicate interface between the public sector assets, imagine a wholesale CBDC in the future, and a network that is really focused on payments and financial applications like Libra. An independent and strong association is really important to this. So when you think about the economics of standard setting organization, what Libra is trying to do here is very similar. You need these founding members to drive utility and adoption, secure the network, and really bootstrap a market for delegation. For those of you familiar with proof-of-stake systems, this really solves the nothing at stake problem that all the systems face. And for this, distributed governance is extremely important, both in terms of corporates, but also nonprofits and social impact partners that can really deliver on that vision. It's also important for avoiding a tragedy of the commons where entities are building on top of the shared rails, this public utility to some extent, without investing enough in R&D in the shared dimensions like security and technological improvements. Now, one of the interesting things, and Anna was hinting at this, is that one of the things we realized really early on was that permissionless has really good economic properties, but also brings a number of liabilities when it comes to the health and long-term integrity of the network. Libra will have a number of provisions around sanctions, compliance, and things like the travel rule, be very much the first blockchain to implement the travel rule natively in its protocol. And regulators were concerned about the removal of such provision in the long run if the network transitioned to fully permissionless. So what we're doing is we're really taking a page from the work that's been done in auction design and market design in general. Think about the spectrum allocation auctions that government have successfully run for allocating spectrum, in really ensuring that over time, both the expansion of membership in the association and its renewal can be done in a fully competitive way. And so the work that's been done here is really blending approaches like the Byzantine fault tolerance protocol that is at the core of Libra, and it's a permission protocol with things and dimensions that can open it up to full competition, very much like a permissionless network. So the idea here is for entities to first clear compliance bar and then to be able to compete in what is essentially free entry in a free market. I will pause there and look forward to having a conversation on these topics. As a reminder, one of the reasons why we believe this can really achieve the financial inclusion and expanding access goals on unbanked and underbanked is that when you think about it, a lot of the barrier today is the lack of competition. And so we hope through a network that is open, interoperable, and that allows anyone to move between different services that we can improve the situation in many different economies. Thank you.
Christian, thanks so much for the concise and fast-paced presentation. I didn't even have to give you the time warning. So with that, Jesse, I'll pass it to you. The floor is yours.
Thanks so much, Robert. Delighted to be here. And thank you to Christian and for Hannah for, I think, teeing up some issues of great interest to myself and my colleagues, and particularly one of those being an area that's getting talked about a lot right now, which is central bank digital currencies. And I think it's really fascinating the way that we've watched the discussion around CBDCs evolve. 5 years ago, when central banks first started putting out papers on this, it was kind of like historians who write papers about what would have happened if the Roman Empire had never fell. They were inherently theoretical, they were thought-provoking and interesting, but nobody really thought that they could possibly be real. Today, we live in a very different world. Sorry, how do I advance the slide here? Oh, excellent, there we are. Today, we live in a radically different world. A January 2020 study by the Bank for International Settlements showed that 80% of the 66 banks that they surveyed, representing a total of almost 3/4 of the world's economic output, are researching CBDCs in some way. A significant number of those have gone beyond academic and theoretical research and modeling to think about practical experimentations, proof of work, with a significant percentage of those moving towards the launch of a pilot. We've already started to see those in Bahamas, in China, and in other places. And some having a very ambitious vision of taking this thing that 5 years ago was nothing more than a theoretical concept and believing that in the quite near future, they will bring it into reality. So I want to just talk for a couple of minutes about what does this actually mean? How does it potentially transform the landscape of payments and value storage globally, as well as sharing a little bit about how at MasterCard we're thinking about engaging with these sorts of developments. So first, I think it's absolutely critical when we talk about central bank digital currencies to recognize that they aren't simply another form of payment. They are nothing like a neobank, for example. And that's because central bank money has fundamentally different characteristics in our economy from other types of money. Andreas Carstens, the head of the Bank for International Settlements, has likened central bank money to the spine of the economy. And so, when you start thinking about building a CBDC, you ought to be very, very careful before you open up the patient that you know exactly what you're trying to achieve. And so what is a central bank digital currency? Well, we already have two forms of central bank money. We have wholesale deposits that large institutions can place with folks like the Federal Reserve. We have the cash and coins that folks like you and I can carry in our wallets. And so a central bank digital currency is a proposed third type of promise from the central bank that is natively digital. But it's actually a little bit more complicated than that, because within this high-level view of central bank digital currencies, there are many different flavors. Some of them are a vision that continues to be restricted to wholesale institutions, really focused on driving efficiency in capital markets, while some of the more ambitious ones look at the possibility of delivering this new form of value token to retail consumers. In some visions, mostly theoretical, the central bank would provide full access to this system. So soup to nuts, your central bank would issue you an app to use your CBDC or a card to use your CBDC. But in most cases, we're seeing central banks recognizing a value of collaboration with the private sector. And the private sector can help drive competition and efficiency in payments and continued innovation in ways of delivering payments. And then finally, and I think this links very much into what Kristen was talking about, while some of these CBDCs are really focused on domestic transactions, others are thinking about international transactions. And as we dive deeper into CBDCs, we can see that very little is clear today. There's an ambition, there's a vision that's being articulated by more and more central banks, but some of them are looking at putting a decentralized system like a blockchain at the other, others centralized. Some are thinking about directly issuing value, others doing so synthetically, effectively allowing stablecoin or e-money providers to place their reserves with the central bank. Some have more cash-like characteristics that we would call a token, others more identity-linked characteristics similar to an account. And there are also big questions about whether they would pay interest and how you would reconcile the challenging and sometimes conflicting goals of ensuring that a CBDC provided the necessary compliance with AML and counterterrorism rules, while at the same time ensuring the privacy of individual citizens. And so you might be asking yourself, why do central banks even feel a need to do that? Well, in this case, I think it's also important to recognize that the motivations driving central bank digital currencies are incredibly varied. In some cases, you have folks like the Riksbank in Sweden who've said, we're experiencing this rapid drawdown in the usage of cash, and we want to continue to ensure that individuals have access to central bank money. In other cases, central banks are increasingly concerned about private sector projects that they see potentially undermining the monetary dominance of their central bank issued currency. They're concerned about the systemic resilience of their payment system and view the addition of a central bank digital currency alongside fully private endeavors as being an opportunity to reinforce those goals of resilience and monetary dominance. In other cases, we're seeing domestic motivations. In South Africa, there's a real focus on delivering something that can support goals of financial inclusion domestically. In other cases, we're seeing, such as in the example of the Bahamas, that when you have 30 islands spread out across 5,000 square miles of ocean, that there's an incredible amount of cost associated with distributing physical cash. And so how can we reduce that? And then we even see in some cases policy-centric motivations. How can we do more efficient government-to-person transactions, or rarely talked about by central banks, but how might we be able to use a CBDC to deploy unconventional monetary policy in an increasingly uncertain environment? All of this leads us to some really challenging macroeconomic and macroprudential questions that have to be answered before we can move forward with CBDCs. There are unintended consequences, such as substituting deposits in large scale, potentially away from commercial banks, and undermining aspects of the monetary policy and commercial credit creation system. There are challenges and questions around how do you secure something as critical as the digital infrastructure undermining the central bank money. And then there are challenges at the end consumer level. Central banks don't necessarily have a lot of experience in providing protections against fraud in terms of governing the relationships between merchants and their consumers. All new things that will need to be thought through. And so at MasterCard, as we're thinking about this, we're both thinking about a set of principles that we bring to our discussions about central bank digital currencies and continuing to noodle on a set of questions that we're looking to help explore with policymakers. We're committed to supporting payments innovation, modernizing payment systems, and seeing where we can help payments evolve within countries, either with a CBDC or with other mechanisms. We're dedicated to the idea that private sector actors, ourselves, FinTechs, and many others, can bring value to ensuring that a CBDC meets the needs of citizens, delivers an excellent payment experience, and continues to have payments innovation. For example, with the delivery of programmability services on top of the CBDC. We think that a CBDC needs to be interoperable, and that existing acceptance points that exist at merchants, the existing terminals that they have, can potentially be leveraged to maximize the day one usefulness of a CBDC. And then finally, we think that ensuring consumer protection is absolutely critical to having a central bank digital currency that meets the broader social goals that in some cases are motivating it. Looking forward, there are big questions. How would a CBDC cross-border collaboration work? Really interesting work being done by the Bank of Thailand, the HKMA, and others on that. How would stablecoin projects, such as the ones that we're seeing discussed today, differentiate themselves or complement CBDC initiatives? How do we trade off this desire to make money smart and programmability with the inherent security challenges that come from that? And then finally, how do we synergize other public sector initiatives, in particular digital ID, which can be critical for things like routing G2P payments? How do we make these initiatives work together in order to better achieve financial inclusion and fairness goals, as opposed to having them move as two disparate systems? And so I think there's an enormous amount of incredibly interesting stuff happening around CBDCs right now, and really excited to talk about that and some of these other topics more as we move into the Q&A and panel discussion.
Excellent, Jesse. Thanks again for the remarks and staying on time. Our last panelist is Christopher, and I'll encourage the attendees to start thinking of questions. Feel free to submit them during the Q&A chat function. I'll try to address them as many as I can in my own remarks, as well as during the proper Q&A. Christopher?
Thank you. I'm Chris Calabia, and I serve as the Senior Advisor for Supervisory and Regulatory Policy at the Bill and Melinda Gates Foundation. I'd like to say hello and thanks to my friends and colleagues at the New York Fed for inviting me back for this timely event. At the Gates Foundation, we believe that every person deserves the chance to lead a healthy and productive life, and we work to improve the lives of the poor by finding ways to increase access to health care and medicine, nutrition, education, and economic opportunity, including access to financial services. Our goal to promote health and productivity are, of course, universal goals for policymakers. And today, these goals face challenges in the shadow of the pandemic. One of our global partners conducted surveys in 5 African countries this past spring. It found that 50 to 79% of households expected to run out of food in 1 week's time, while 73 to 88% of households expected to run out of money in a week's time without assistance. Now, many lower and middle income countries are delivering assistance in the form of cash transfers, especially digital cash transfers. To date, at least 180 countries have expanded or introduced cash transfer programs to mitigate economic hardships related to COVID-19, as indicated in the chart that I hope you can see on the screen. The latest figures suggest that the cash transfers have been sent to about 1.1 billion beneficiaries since March of 2020. As we look forward to the recovery, digital financial technologies could help us to build back more inclusive, secure, and resilient economies. In this regard, digital non-bank payments providers have played a critical role in expanding access to financial services since well before the pandemic, and may position many countries to build back a more inclusive digital economy. 15 years ago, mobile network operators began experimenting with basic financial services, principally payments, and perhaps the best known example might be the innovative M-Pesa service launched in 2007 in Kenya by Safaricom. Sub-Saharan Africa today leads the world in the use of these non-bank mobile or e-money services, where today about 21% of adults have an e-money account, a near doubling since 2014. Now, might digital currencies such as stablecoins or central bank digital currencies likewise help to expand access to financial services? And I'm delighted today to share some personal reflections based on my recent note on this subject, could the poor bank on stablecoins? Now, if we expect the poor to rely on stablecoins for their daily payments, let's consider how the performance of the underlying technology compares to existing digital payment solutions. And Hannah gave a great introduction to Bitcoin earlier. The encryption, or what she called the mining process, used to secure the distributed ledger for crypto assets like Bitcoin, is computationally intensive and burdensome by design to strengthen confidence that the shared ledger is authentic and immutable. And as a result, Bitcoin processes only about 3 to 7 transactions per second. This speed is well below what existing digital payments providers in some lower and middle income countries offer already, as you see in this slide. What users care about, though, is a related issue, namely the latency in a transaction, meaning how long do I have to stand in the grocery store waiting for my stablecoin payment to settle? If it takes too long, a consumer may get frustrated or even try again, potentially sending 2 payments rather than 1. Now, before any blockchain fans hang up on me, let me acknowledge work is underway to increase the transaction speed or simplify the underlying processes. To gain widespread acceptance and use among the poor, consumers may need confidence that stablecoin initiatives will at least come close to matching the performance speed of existing digital payment services providers. The flip side of this issue is ensuring that low-income households have technology that will support stablecoins. And as Christian noted, 1.7 billion adults lack access to a formal financial account today. But of those, about 1.1 billion own a mobile phone. So the mobile phone may provide a good way to reach these many of these people. The challenge is that not all mobile phones are alike in technological capacity. Smartphones with advanced computational power and the ability to run third-party apps are prevalent in high-income countries. Simpler and generally less expensive feature phones account for 60% of mobile network connections in sub-Saharan Africa and about half of all connections in South Asia, the Middle East, and Northern Africa. Feature phones typically have lower processing power, physical keys, and displays limited to a few lines of text. As an example, a feature phone can send messages that are up to about 160 bytes in size, or 182 characters, like instant messaging apps. Bitcoin messages are longer. The simplest Bitcoin transaction requires 250 bytes, and the average Bitcoin transaction requires 600 bytes to communicate. Most stablecoin initiatives are currently optimized for smartphones, though some innovators are experimenting with platforms for feature phones. If we fail to bridge the technology gap, the poorest consumers who are more likely to use feature phones may not benefit from stablecoin offerings until the cost of smartphones falls or the technology of feature phones increases. Now, interestingly, this in turn could inadvertently reinforce the gender gap in access to financial services. Women in low and middle income countries are 8% less likely to own a mobile phone and 20% less likely to own a smartphone than men. This could mean that women may lag men in using stablecoins. A third open question to consider are the costs, as even low costs could be material for the poor. Remittances came up earlier in Jesse's conversation, and these may be one of the most interesting applications for stablecoins for low-income countries, especially if stablecoin-denominated remittances could lower the stubbornly high cost of sending wages home for migrant workers. Now, even if transaction costs for stablecoin-denominated remittances are zero, workers sending funds to their family in their home countries face other costs found in what's called the bid-ask spread when they exchange one currency for another. If you've traveled abroad, you probably noticed that you lose a little value when you exchange your money because banks buy foreign exchange low but sell it high. Workers using stablecoins to send remittances may face two foreign exchange transactions and hence two bid-ask spreads. Once, for example, when a worker converts dollars to stablecoins, and a second time when her family converts the stablecoins into the home country currency. This friction could increase for workers who migrate to countries with currencies that are not widely used internationally. If a worker needs to purchase a hard currency like the US dollar before purchasing a stablecoin, they may face three bid-ask spreads. Now, exactly what the bid-ask spread might cost a worker to buy a globally accepted stablecoin is an open question. One recent research paper found that bid-ask spreads on currency pairs involving an illiquid currency and a liquid hard currency like the US dollar can result in a loss of value equivalent to two-digit percentage costs to clients, about 10 to 15%. If this relationship holds for illiquid currencies and more liquid stablecoins, the bid-ask spread could ultimately impose high costs on migrant workers. In comparison, the average cost of sending a remittance ranges from about 5 to 10%, averaging about 7%, as mentioned earlier, on a $200 transfer. Innovators seeking to offer stablecoins as a solution to remittances should look carefully at the costs that the poor may bear when trying to use these crypto assets. If stablecoins become widely accepted across consumers and businesses, governments may decide to regulate them to safeguard financial stability and protect consumers against harm. Since low and middle income country regulators have suggested that stablecoin initiatives look a lot like a product called non-bank e-money, let's consider how existing customer funds protections in lower income countries on e-money might apply to stablecoins. And we'll start in the lower right-hand corner of the triangle. Here, the consumer gives a non-bank provider cash, and the provider issues the consumer e-money in a digital account in exchange. In many low and middle income countries, regulations require the provider to deposit the customer's funds into a commercial bank account, shown on the left-hand side of the triangle. In some countries, the commercial bank becomes a trustee of these funds and has a fiduciary duty to return the funds to the consumer should the e-money issuer fail. Now, how might this apply to stablecoin providers if this type of regulation is applied to them? It's not entirely clear how this would work. Because of the existence of the asset basket supporting the value of the stablecoin. The asset basket could, as mentioned, hold one or more hard currencies, which may be held in an overseas jurisdiction visible on the left-hand side of the slide. So when the stablecoin issuer receives funds from consumers in the host jurisdiction, the issuer may exchange those funds for hard currencies and transmit that hard currency back to its asset basket at home. We still don't know how the local stablecoin wallet provider could then comply with the trust-style arrangements that I just described if those customer funds are converted to hard currencies and sent overseas instead of being deposited in a local commercial bank account. This remains an open question. Related to this point is what the impact could be on countries with low foreign exchange reserves if they adopt stablecoins on a large scale. Traditionally, incoming foreign exchange denominated remittances are added to the stock of that country's FX reserves or foreign exchange reserves. Those reserves help the central bank to carry out monetary policy, to service foreign exchange denominated debt, or to invest in the infrastructure. If a global stablecoin scheme requires an exchange of hard currency for stablecoins, might a low-income country's foreign exchange reserves dwindle? And would its ability to conduct monetary policy or service foreign debt dwindle with it? Presumably, central banks could hold stablecoins as part of their FX reserves, but it's not clear whether stablecoins could be used to conduct monetary policy, service foreign debt, or invest in infrastructure. And central bankers and policymakers should think about this. Now, despite these 5 open questions, we should welcome innovators' efforts to find ways to improve the lives of the poor. Dialogue is critical to ensuring that stablecoins and other digital solutions will safeguard financial stability, prevent abuse of the financial system, and include and protect all consumers. At the Gates Foundation, we believe that everyone benefits from an economy that includes everyone. We invest in 3 public digital goods to pursue this vision, which I'll mention as a placeholder for now. The first, as was mentioned earlier in some of the other presentations, is a real-time interoperable payment system that allows consumers, businesses, and government agencies to conduct transactions regardless of providers. Our platform is called Mojaloop. We also invest in inclusive digital identity systems so that everyone, including especially women and the poor who often lack identity documentation, can meet Know Your Customer rules to open accounts. And finally, we invest in data sharing protections. Plus, we'd like to see a full range of prudential regulations to be adopted to safeguard digital financial services and promote a more inclusive financial system and a more inclusive economy that enables everyone to lead a healthy and productive life. Looking forward to our conversation today. Thank you.
Excellent. Thank you, Christopher. And again, thanks again to all the panelists for the very interesting remarks. A lot of questions I'd like to get to, and hopefully we can try to get to as many of them as possible. So a lot of interesting topics came up that I'd like to dig a bit deeper into, especially, again, given the current dynamics we are living in. The pandemic, as I alluded to in my earlier remarks, brought forth some of the shortcomings of our existing systems. And then some of the technologies we addressed today by the panelists aim to address those shortcomings. For instance, I should mention some of the research my colleagues and I at Columbia and on other schools have done in regard to looking at the impact of the pandemic on consumer expenditure and the stimulus checks. And these papers were published actually back in April and May. We are quite proud that we were the first team to do that, and that's purely because we had access to this real-time, high-frequency, longitudinal consumer transaction data that for the first time allowed us to do something we couldn't even do as late as 2008 crisis, and that is be able to see what's happening on the ground from a research perspective for us in academia, and also shorten that latency that exists between a policy formulation and implementation and measuring impact. I'm specifically referring to the stimulus checks. But we also saw a lot of issues, for instance, identity that Hannah and Christian alluded to. And I'm going to actually pose the first question to you both. In a sense that it's very easy for us to send money to the government, but money from the government coming to us, has to go through so many loops. And we saw many people who were eligible for the stimulus checks didn't get them, or there were a lot of fraud embedded into those efforts. Unfortunately, those who were eligible to get them did not get them, identity theft, and so on and so forth. Also, some of the notions, especially around low-income households and all the kind of dynamics in regard to savings, payments, and so on and so forth. So, Christopher, I'll come back to you on those issues. And on a macro level, all the things that are on they should be on our horizons, and I'll ask Jesse about that. First and foremost, question to Hannah and Christian. So this notion of identity, many people ask me what I think is the killer app for blockchain. I think it's very complicated and difficult question to answer. I don't think anyone could have predicted that Facebook would be the killer app for internet. But nevertheless, at the end of the day, some people say financial services, some people say payments, and so on. But I think at the end of the day, identity is the crux of the matter. If you haven't solved for identity, all these conversations around payments and financial systems leveraging blockchain perhaps become less relevant. So I'm very curious about your views and looking at permission versus permissionless blockchain capabilities, because on one hand, at Facebook, vast majority of users do have their real identity, whereas in Bitcoin, we have no idea who these people are. They're just behind a wallet. So Hannah and Christian, your thoughts on challenges around identity and some of the latest you see on your horizon that could address issues around that topic.
So I think that identity is a very important issue and really needs fixing because so many other things depend on proving your identity and having it verified. And we have we hold great hopes for blockchain. It has so far proven very limited. And there is a reason for that. Blockchain is only going to move information that has been put in there. Somebody needs to put this information on the blockchain. I call it a gateway problem. So if you are talking about identity, somebody needs to affirm this identity, and it cannot be the participant himself. So permissionless blockchains, we don't need an identity that is a consistent identity. We just need an account for a particular payment, for a particular transfer. So this is not going to do the job. So it has to be permissioned in some way. Somebody needs to vouch for your identity, and this identity needs to carry from one transaction to another. Blockchain is not going to prevent us from identity theft. whatever security features we have in digital world, they may be even easier to copy than unless it's a fingerprint, right? But then if it's a digital fingerprint, then or a digital representation of a fingerprint, like on your iPhone, you can bypass it by providing bits that represent the fingerprint. So inherently, we are not going to fundamentally go away from the possibility of identity theft. We can develop better tools to protect for individuals to protect their identity, to protect their private keys and other forms of identity. And blockchain basically moves the information. If we do not put verified information on it, then it's not going to help much.
Great. Christian?
Yes, happy to provide some thoughts. So first of all, I think identity, very much a lot of the payment infrastructure needs to be built as an interoperable internet standard. And it will not happen without public sector participation. I think, the public sector has a really important role to play in identity. There's clear externalities around it. And where the private sector can help is in building infrastructure and tools for APIs and interfaces on top of that are truly open. So again, I think about the standardization process that could take place in an institution like IETF, IEEE, or W3C. That's the kind of effort we need to improve identity. Why is that important is because, when we looked at what Libra can do in terms of unbanked and underbanked, the real frictions are all on the last mile. And of course, as Christopher was mentioning, mobile phones, things like M-Pesa have made tremendous progress in that direction. But identity is still a major bottleneck for reaching segments and serving them. Some networks allow what are called unhosted wallets. Libra will not do that because we don't think there's a safe and compliant way to do so at this point. And so we think improvements on identity will be really important for serving more segments and really working towards financial inclusion. Now, I think the good news is that we shouldn't think about any of these ecosystems as static. So I think we heard a number of really important metrics, transaction per second, transaction fees. All of these are being improved on at the speed cycle of digital assets, which is much faster than the traditional fiat rails. So just for an example, one of the leading stable coins has spreads of 5 to 10 basis points. Those are really narrow relative to a lot of the alternatives. And yes, many of these don't interface with feature phones today, but I think you'll be able to build all of this and maybe around identity too, together with the telcos in some of these regions, to really ensure that we can bring these people online. We can start providing them with basic payments, which are often the starting point for more sophisticated financial services. Now, I think one thing that's going to be important around identity and also around issues that were mentioned on currency substitution, all of this needs to happen within frameworks that work in coordination with macroprudential policies locally. The last thing you want is for a stable coin denominated in a foreign currency or a hard currency to threaten monetary sovereignty and induce currency substitution. The good news is that these systems are digital, so they're actually much more easy to regulate and structure in the right way. So a simple balance limit, addresses the currency substitution risk quite effectively. And over time, I think what we should encourage is for these emerging economies and developing markets to build those rails to interface with this network so that citizens can actually transact in their local currency. I think it'll take us some time to get there, but like identity, which is a very complex, thorny issue that I think a lot of consortiums have tried to tackle in the past, unless we work all together, it's going to be sort of useless because the bedrock of this needs to be interoperable, not just within countries, but I think we've seen tremendous progress in places like India and others, but also kind of cross-border. And that's really the difficult piece. So that's kind of how we're thinking about the problem, really as a coordination where the more we can improve identity standards, the better we can build interoperability around identity, the more we'll be able to actually achieve financial inclusion, because otherwise, of course, you'll end up serving the same customers that other banks and financial institutions are serving today.
Great. And Jesse,
Robert, I wonder if I can. Yeah. I think just a comment on identity is a really difficult problem, and I think that there's a frequent tendency to treat blockchain as though it can be a silver bullet for addressing that problem. And I think that this is a problematic idea, and I'll just talk for a second about why. Blockchain is a great mechanism for keeping a disparate group of entities on the same page about something. A ledger It's distributed. We all keep on the same page. But it's not a tool for getting entities onto the same page in the first place. It's not a system for building alignment. If we think about identity, identity is a trusted bridge. It's someone who knows me and will attest something about me, and who you have reason to trust knows that. And so when we think about building a sustainable ecosystem for that, it's really difficult. Blockchain can be an important enabling technology, but it doesn't bring together all of the entities needed for a rich and private and a privacy-preserving digital identity on its own. That governance framework needs to be catalyzed, and you need to get all those players aligned before you actually can implement blockchain as an underlying enabling infrastructure. Great,
thank you. Next question I want to ask Christopher. Actually, two questions related. One is that the pandemic, in my view, accelerated adoption of digital payments in general, especially in developed countries. You look at a country like Germany, you would see a lot of cash transactions that have quickly changed toward digital transactions in general. And so in essence, developed countries are kind of catching up with developing countries in regard to adoption of digital payments. Now, do you see the same happening in developing countries, that despite some of the constraints you mentioned in terms of technology or access, there is this continuous push toward digital payments, number one? And number two, in a prior conversation, you brought up an interesting issue, especially around low-income households, and that is a lot of activity around addressing challenges faced by those low-income households has been around helping them save money with savings. Whereas you brought up the point that perhaps it's also the policy of the foundation that actually addressing digital payments is more important. If you could talk about those juxtaposition of those two topics, I think would be a fun conversation, and the fact that whether you think they should be done in sequence or can be addressed in parallel, in tandem.
Yes, thank you very much. I'm happy to address those questions. Let me just weigh in quickly on identity as well. That is one of the fundamental drivers of inclusion of all kinds. In many countries, you can't participate in society fully if you can't prove who you are. You can't enroll in health insurance, you can't send your kids to school, you can't vote, and you can't open an account or even buy a SIM card for your cell phone. And so identity is one of the major things that we focus on as well. And we promote open source solutions and research into this work, including sponsoring a project with the World Bank looking at how identification can be used to promote development. This is critically important for women's inclusion as well, because in some lower income countries, 44% of women lack identity cards or numbers. In terms of the adoption of digital payments and the strength of the digital infrastructure, research that we've sponsored during the pandemic has shown that when countries have a well-functioning digital infrastructure in place, they are better able to deliver necessary cash transfers to vulnerable citizens and households, including furloughed workers and even some small businesses in some cases. And so it was easier and cheaper and faster for those countries, including some low-income countries, to get assistance to households quickly and safely. Interestingly, those countries also were able to enroll previously unbanked people faster and easier into accounts for the first time so they could receive digital cash transfers to help them weather the economic hardships of the pandemic. So having a well-functioning digital infrastructure is quite important. And as you mentioned, in high-income countries that didn't rely as much on digital payments, there's been a lot written in the press about the difficulty of getting people the necessary cash through the mail, for example. With regard to the issue of what drives inclusion in lower-income countries, for a long time, there was a lot of focus on trying to increase access to savings accounts, and that's the type of product. However, the analog brick-and-mortar banking system doesn't work well for people who are living in rural or highly impoverished areas. The cost of building brick-and-mortar branches is too high, and the margins are too low for traditional approaches to banking to work in these types of communities, especially in low and middle-income countries. And so the experiments that took place about 15 years ago by mobile network operators worked well because they had a huge installation base, if you will, of customers already, including among very low-income people. And they didn't need necessarily to have a physical presence in all the communities in which they wanted to serve these individuals. And when they discovered that people were trading airtime minutes, which is how M-Pesa started out, originally people would send each other airtime minutes to make small payments. Safaricom and other companies in Kenya, East Africa, as well as the Philippines began to offer very basic digital financial services accounts. This turned out to be a game changer because they could offer those services for, in some cases, 90% less than the cost of a traditional brick and mortar bank. And that became the big driver and the entry point for many people into financial services. In fact, most people gravitated first, who were previously unbanked, that is, most people gravitated first towards a digital payments platform. And later, as their incomes improved and as their financial stability improved themselves, they were able to then open savings accounts, often with traditional commercial banks. So it's been a really interesting development, but we still view the digital transaction account as as the likely venue or avenue for banking the poor in the future.
Great. Now, to follow up question for Jesse. Jesse, given your current role and also prior role at World Economic Forum, you have an interesting vantage point. You get to see a lot of things on a macro level. So in the context of cashless society versus less cash society, and when it comes to addressing access to financial services, inclusion, savings and payments, what are the technologies or applications that you see on your horizon that you feel should be on everyone's radar screen? And what are the things specifically in addressing inclusion excite you the most that you see throughout your work?
So I guess I'll talk about two things that I think are really interesting that are happening right now. The first is work that's being done in the cross-border space. And the second is a way to think about inclusion vis-a-vis central bank digital currencies. So I think Christian pointed out, and Christopher as well, that there are challenges with the cross-border space. While many transactions complete relatively quickly and at relatively low cost, some take significant amounts of time, lack visibility for users, and have significant costs, particularly relative to the size of the transaction associated with them. Our view is that this is the product not of a single problem, but of a complex set of problems overlapping between legacy systems, significant layering, a lack of regulatory alignment from region to region, costs of liquidity, opening hours for real-time gross settlement systems, and much more. And as such, we don't think that it's possible for any one entity, or certainly for any one technology, to address this challenge. And so we're really interested in the work that's being done right now by the CPMI, the Bank for International Settlements Committee on Payments and Market Infrastructure, who are thinking about a multi-party roadmap for addressing this that they'll be delivering in November to the G20. Effectively thinking about how can private actors, regulators, and governments come together to collectively try and address the type of underlying issues that are driving up the cost of cross-border. The second thing that I'd talk to is financial inclusion, and reacting a little bit here to a question that came through in the Q&A about whether or not distributing CBDCs through the private sector would undermine their financial inclusion goals. I think before we think about the specific answer to that question, we have to take a step back and ask ourselves, what are the challenges that we face in terms of financially including those who are excluded today? I would agree with Christopher in saying that identity, access, and costs are the key contributors to whether or not individuals today have access to financial services. That's not notably a question about access to central bank money. And thus, a CBDC is neither necessary nor sufficient on its own to delivering financial inclusion goals. Instead, what we have to do is to think about how we address those issues of why people don't have access to value storage accounts and payment systems today, and we have to look at addressing them. And I think that the private sector can play a really important role here. It drives competition in the provision of payment systems, it drives innovation, and it drives a focus on serving niche groups. And so if we think about a CBDC as a two-layer system, wherein a highly efficient CBDC, or frankly, real-time payment system, provides access to a set of rails, which then has private sector providers competing to provide access to niche groups, to the value storage and the rails associated with those, then I think that that's the best way to move towards financially including, particularly in advanced economies. This, as Chris, I think, well lined up, as you get into emerging economies, this becomes also an issue of bridging the digital divide, which is less the case in Western Europe and the United States right now, though still unfortunately an issue here as well.
Great. Now I encourage all the participants to submit questions in the Q&A chat box. I'm monitoring them live. And now, actually, open question for the panel. One of the most exciting things about blockchain is the possibility of us creating tools that we couldn't even imagine before, things like programmable money or colored money, and so on and so forth. And in today's conversation, a lot of topics have come around CBDCs. Now, one, do we believe, or the belief of the panelists, that CBDCs need to be done at a federal level, central federal level, or can we experiment with implementation of them at a smaller scale? Like in the U.S., North Dakota is the only state that has a state bank, public bank. And two, most of the CBDCs, this is a question from the audience, do not seem to be focused on programmability thus far. Do we believe that's because of certain constraints? And if so, what are the top 3 constraints that you see in terms of infrastructure limitations and so on and so forth? And how far are we from having programmable money, given the fact that it could solve problems? Like, instance, I give you stimulus checks, you can only spend it on certain things. You cannot buy alcohol, but you can buy a washing machine, durable goods, and so on and so forth. So open question to panel. Anyone feel free to jump in, giving your thoughts on this.
I can jump in and grab please, go ahead, Hannah.
So I just wanted to mention that we actually have had programmable money for a while. Food stamps is an example of programmable money. Right, and the thing is that so food stamps have built-in restrictions on how can they be spent, and we were a long time ago we have moved to digital food stamps, so they are already kind of programmed in how they can be spent. So it is not true that that it is only now possible. Now it's possible on the large scale, but the question is, how it raises concerns about paternalistic limitations to how people should and could spend their money if you are giving them money. So and how costly would it be to not actually program the money, but to decide what are you going to allow to spend them on or not. So there are a lot of concerns, and I think that the first step would be to even get CBDCs out there like we have with regular cash. And then the next step would be, can we make it even better? But technologically, it's possible, but why now?
Jesse?
I think Hannah raises an excellent point here, which is that there's a frequent tendency to conflate decentralization and programmability, but that is not necessary. It is possible to impose programmability within a centralized system. Now, lots of legacy payment systems don't have that facility, but if you're building a new payment system anyway, you could theoretically do that, offer programmability within either a centralized or a decentralized system. The challenge that a lot of the central banks that I've spoken with see around programmability is a trade-off with security, as well as a trade-off with interoperability. So based on the conversations I've had, suggest that there was initially an intent with the PBOC's DCEP program to have a rich layer of programmability that was ultimately stripped out due to interoperability challenges that it would create to providing functionality through chips, as well as a notion that as you make the base layer for a CBDC more complex, it introduces a broader threat surface. And so what you're seeing in a lot of central banks is exploration of a multi-layered system that would have a highly secured core protocol, but then would enable the provision of value added and layered on services that would offer some degree of programmability.
Yeah, really building on that, I think that's exactly the way to think about it, where you're at different levels of the stack with the public sector really providing the ultimate settlement rails and the safest rails for any application. And then you can take a little bit more risk and experimentation in some of the stacks on top of it, whether it's for delivering payment experiences or some other financial applications. With Libra, one of the decisions that was made really early on was actually to not enable full programmability exactly for the risks that are involved in systems that are open to any sort of full Turing programming capabilities. We've seen smart contracts go and add side effects before, and if you cannot formally verify that a piece of code is only going to do exactly what you expect it to when it comes to financial systems and financial applications and payments, that can be very dangerous. That said, one of the things that it's important to keep in mind, and this is where, yes, the food stamp is a good example, but if we drive the analogy to the limit, is a vending machine a smart contract? Well, it is, but it isn't. I think one of the challenges that we often face is that for these programmability to be actually meaningful, for it to enable the kind of innovation and positive effects on the economy that we've seen with the internet, it needs to be fully open. It needs to be fully interoperable. We don't need more proprietary APIs. We need open, interoperable APIs that look a lot like the standards that we're using every day, TCP/IP or email protocols. That's the kind of programmability we should be building. And I think we can deliver different levels of complexity at different parts of the stack. So completely in agreement with what the other panelists were saying on that.
Great. Question for Christopher. Looking, in your remarks, you talked about a number of issues as they pertain to financial inclusions and kind of moving away from some of the existing models that haven't served the low-income households or those underbanked or non-banked well. So do we believe that CBDCs, if they were to be used through financial intermediaries, can actually address some of these challenges? Or are we just kind of kicking the can down the proverbial road and just changing how they are being used without addressing the fundamental challenges low household incomes face?
So, Robert, the answer is, of course, it's going to depend on the design and implementation of the CBDC. And so some implementations could solve a lot of the problems or a lot of the open questions, rather, that I cited. So, for example, if you're not relying on an open or a shared ledger and instead have somebody managing that ledger, you might not need to use all the cryptographic processes to encrypt and mine the blocks and make people more confident about their immutability, because the central bank might be monitoring and managing that ledger. So that might reduce the processing needs of handsets, and it might be easier for you to use a feature phone to access central bank digital currency. So it's really going to depend on how it's designed and how it's implemented. Ultimately, though, one of the most important things to bear in mind is that whether people decide to enroll in a financial account and use any type of scheme, whether that's a digital payment scheme or a central bank digital currency or something else, will depend on whether they trust the system. Do they feel that their best interests are at heart? Do they feel that there's someone watching out for them? Do they understand their rights and responsibilities when they use these new technologies? We've seen that this can be challenging, especially in countries where literacy, or in communities rather, where literacy or numeracy even might be low. And therefore, we need to do a lot of thinking about what the right design is for products and services. And so the Gates Foundation has published a paper, for example, called D3, which looks at what it takes to digitize, design, and deliver financial services and financial products to women in a way that meets their financial needs. So thinking a lot about the user's needs, but then thinking about how the system is designed and whether it engenders trust is going to be critical to any kind of digital deployment.
Another question from the audience. This is for Christian and Christopher, the two Chris's on the panel. One advantages of cash, including for unbanked or underbanked, is that If you were to keep it at home under a mattress, creditors cannot touch that money versus that money being in a bank account and so on and so forth. So from a purely policy or societal perspective, should CBDCs retain any kind of capability like this? Or what are the considerations that we need to take into account when looking at complicated questions such as the one posed by participants?
Happy to get started. I think there's one dimension which is probably even more important than the one in the example, which is privacy in general, right? Cash does provide some degree of privacy, and there are good uses of that privacy in society. And so how do we build a system that can protect those users while, of course, preventing the abuses and financial crime? I think that's one of the main challenges in any digital system. That are some related thoughts, but I understand they don't address exactly the example in mind.
So thank you, Christian, for taking the first effort at that. I would agree it's a hard question, and it might be best left to lawyers and people who think about these issues more carefully. I would say, again, that consumers, in order to encourage consumers to make use of central bank digital currencies, they're going to have to believe that the system is fair and that it's transparent. And whatever we can do to promote protections for consumers with regard to privacy and with regard to their ability to control their funds, subject to appropriate regulatory limits, judicial limits, and so on, I think will be important. But making sure that it's fair and transparent is going to be most important.
Excellent. I'm going to try to squeeze in one last question for Christian. Christian, in your presentation, you talked about some of the measures that Libra takes in order to address questions around fraud, integrity, and so on and so forth. A question from a participant is around fraud considerations and solutions to address them on a broader scale at the CBDC level. How different would those measures be, in your view, from those implemented at Libra, if any?
I think there's a lot that the public sector will be able to borrow from the experience of many efforts in this space. In general, I think the good news is that digital assets provide much better digital trails. And again, we already mentioned the privacy concerns, but clearly there's a possibility here to do much better than the current system. I think often we talk about financial inclusion being stopped by the very high compliance costs, but when you really look at the picture, it's not that the current compliance and AML controls are catching a lot of the criminal activity. So again, I think there's a lot here, and it relates to identity that we can do all together to improve the safety and reliability of the financial and payment system.
Excellent. Thank you for that. We are right on time in our need to take a break. And so first and foremost, I'd like to thank all the panelists for giving us their time and the presentations, and also addressing all the questions, my questions, as well as the audience members. So I really appreciate that. As a slight shameless plug for the FinTech Initiative of Colombia, do feel free to check us out. A lot of the topics that we brought forth are also very much top of mind for us. You can see us at the link up here. And also thanks again to all the organizers at the Federal Reserve. So Asani, I'll pass the baton to you before the break. And thank you for inviting all of us yet again to the FinTech conference at the New York Federal Reserve. Thank you.
Thank you, Robert, for moderating the panel. Thank you to all the panelists. That was a really stimulating discussion. I really learned a lot. There were a lot of really rich insights. And I think I'll be listening to the recording as well, because I couldn't follow everything in real time. So we are going to take a break now for 15 minutes, and we'll be back at 12:45.